Let's just put all of this into perspective with Rohit Srivastava, founder and market strategist, IndiaCharts.com, who joins us this morning. Rohit, good morning. Well, not sure if you would call it a good morning looking at the charts this morning, but beyond the charts is the underlying slippery story of oil. And oil is now, in fact, crude is nearing the $120 a barrel. We saw WTI inch up to about $117 a barrel this morning. And a lot of disruptions further expected because oil is now at a 2-year high, with Qatar warning that overall production in Gulf could be hit. And of course, all this coming on the back of US continuing to bomb Tehran. In fact, it bombed Tehran's fuel depot, and Kuwait has also cut oil supply from the region and into the rest of the world. Meanwhile, there's a new sort of statement which has come from Goldman Sachs, which is saying that oil could hit as much as $150 a barrel if the Strait of Hormuz continues to remain shut. What are you making of the oil story? How slippery is it likely to be, not just for Indian markets, but for the Indian economy as a whole?
No, it's not good news for sure. I mean, the strategies we've had is to tell people to keep hedging. If you don't want to create cash on your portfolio, you would have hedged with, long-dated put options. That was the strategy that we took. But what happens here, if oil prices remain elevated, is that you do see a slowing down of economic activity. And it's not just about high oil prices, it's also about the supply of oil that goes into so many industries. And if that supply runs out and is not filled, then you can't produce the same as you were doing before. What also happens in an economic war environment that becomes prolonged is that a lot of plans get shelved or get postponed. So if you have capex plans, you're probably going to say, okay, let me not invest this now. Let me wait a little longer and then start out to play out my investment themes. And that itself causes a slowing of growth, not just in India, but also at a global level. So we start looking at a slowing global economy. And that is what I think markets are starting to price in today, because we are going from saying that this was going to be a 1 week or a 4-day war to saying that it's going to be 3 to 4 weeks and who knows longer. And that's the fear that I think has started to hit markets on Friday and even more strongly today.
Talk to us specifically about oil marketing companies, because these stocks are taking a massive beating in trade this morning. In fact, BPCL is down about 7.5%. Hindustan Petroleum is down more than 7%. IOCL is down about 6.5% or so. Overall, are there fears now of the sticker shock also to come in? Are we likely to see retail prices of petrol and diesel also to come in? I understand that this is, of course, also the time when there are 2 states which are going into elections. So the government will want to be very, very careful about not letting, the sticker shock hit Indian consumers. But overall, with the action that we are seeing in West Asia, and I'm looking at stocks of BPCL, HPCL and IOCL, is there a likelihood of a sticker shock for Indian consumers?
I don't think so. Historically, the way we've managed this used to be through something known as an oil pool account.
Yeah.
Definitely, the government hasn't desired to go back to that, so it was done away with.
Yeah.
But it really works in situations like this, where you want to protect the companies involved, at the same time not change market prices. So the government used to take the hit through the oil pool and allow the oil marketing companies to remain profitable. So that was the solution of pre 2000 2005. Now in the current environment, the oil marketing companies would take a hit because prices can't be raised and the government would not allow them to go up too much and create chaos. Maybe they provide some temporary relief. So we can't rule out that you get a 10% or a 15% oil price hike at the pump, but that might not be sufficient to take care of the losses they'll face because of the jump in oil prices that we are seeing right now. So, but yeah, some adjustment, but I don't think it will be as as significant. 10-15% moving prices higher is a possibility that we should keep in mind.
Okay.
But would the government step in and provide relief through some kind of temporary tax cuts? That would help. Let's see if it really happens.
Right. So I think there are expectations that the windfall tax is finally going to be cut for, for oil marketing companies as well as oil refiners, oil producers. But our investor fears right now, looking at oil marketing companies, the fact that there may not be a sticker price increase in cost of petrol and diesel, and hence profitability is going to take a beating. Is that the single worry right now, that oil prices will continue to rise or will stabilize at higher levels, but that may not be passed on to consumers, and hence profitability will take a beating?
Definitely, that's the straightforward case, because we are not like the US, where oil prices are directly linked and prices per gallon just move up based on the price of crude. In India, it's very much controlled, even though we have a supposed free market. The prices are set from time to time. And if they are not changed regularly, it ends up impacting the underlying companies. So that's a very straightforward equation.
All right. And surprisingly, Reliance Industries is down just about, what, 1/3 of a percentage point or so. One would have feared that refiners like Reliance are going to take a beating with higher import prices of crude oil. Is that not something that investors are worried about?
So I guess there's it's slightly tricky. I'm not sure how to discount the Reliance case. Sometimes higher oil prices is not such a big issue if you're passing it on, which is unlike the OMCs, right? You can pass on the price at a refining level and still maintain your margins, but that may not be possible for a oil marketing company. So that's probably why it's not taking a bigger hit. But eventually, if markets are weak, you might see pressure build generally just because of markets. But yeah, that's the differentiation between marketing and refining.
All right. Okay, I want to pivot away to other sort of, single day shocks that the Indian stock markets have withstood over the last almost 2 decades or so, Rohit. And I really want to understand the learnings from that. So, back in 2020, 13% crash on March 23rd. This was the day that the lockdown was announced for the first time. We saw Nifty 50 tank about 13% or so. Then came, back in 2024, I beg your pardon. I think, we've got that date wrong over there. But back in 2024, we saw the general election result at, which took the stock market down, Nifty 50 down about 12.2% before it closed higher. Back in 2008, we saw the global financial crisis, the meltdown, which took Nifty 50 again down. It was trading at lower levels. It took it down to about 12.2% or so. And then we had the subprime crisis, the build-up of subprime crisis back again in 2008, which took the markets down to about almost 9%. And then we had, of course, the fear of the pandemic back in March 2020 when the Nifty 50 had climbed down about 8.3%. So we've seen pretty much in bad days, from those bloody Mondays to panic Thursdays and whatever not. We've seen Black Fridays. We've seen pretty much, oil prices, no, not oil prices specifically, but markets tank from a range of about 8% all the way to about 13% or so. So this 3% fall that we are seeing today, what does history tell us? That is this really something which one should panic about, or just weather it out? We know it's a temporary blip, and hence, what should the strategy of retail investors really be?
So yeah, it's a little late. Sometimes you feel, to start hedging or to start reducing risk on your portfolio. It's something we've been saying since January, that creates some cash and, be on the side for various other reasons. War was definitely not what we were citing. But if you put it together, if you mix up war with already a slowing economy, and now the credit problems that are showing up in the private credit market for the US, and it all gets mixed up, then you have an overhang that can get troublesome, especially when you move towards risk aversion. Risk aversion is a situation where if global funds, which provide most of the liquidity out of the US or out of Japan, start withdrawing from global equities, and then it goes back into US bonds. So the way to judge that is if you see the dollar rising and you see US bond yields also coming down, which means bonds rising. When the dollar and bonds rise together, it sort of gives you a sense that funds have decided to become risk averse, and it creates a risk off environment. And in that scenario, you can get those kind of bigger declines like the ones that you have actually highlighted, because then everybody would want to be selling and getting out of the market at the same time. And when would they do that is when they clearly sense that this is going to be a prolonged conflict. I think the sense of that has already come in. Right now, you don't have US markets open, but the future is already down 2%. If that accelerates through trade later in the evening, you would see a much more significant impact on both Asian and Indian equities, into tomorrow. So we need to be mentally prepared for that risk. If you're not, one way is to really look for hedges. I know we're already below 24,000. The last hedges we took on were 25,000 puts. Those have already more than doubled. So I don't know whether I can tell people to, look for 24,000 March, which is a very long duration. But at least for March, if you can, do some kind of hedges, that would actually help you. I don't mind really increasing cash levels in a portfolio to maybe 30% of more because that then reduces the risk of a drawdown
Okay.
overall. Say for example, you get a significant drawdown in your portfolio, it can be reduced by more than half by having a 30% cash level. So that's one way. You don't really necessarily need to sell out everything, but if you create some level of cash, it helps you bear the drawdown much better.
Okay, but how do you generate that cash right now? If this is the situation of the markets, what kind of sectors or what kind of funds should you sell to be able to build that cash position?
So so there are many sectors which have actually done well even into last week. We just saw banking start selling off, So the weakest sectors of the last year were, of course, IT, reality. That's already done and dusted. So if you're still there, you're still in the weakest segments, but you might still be holding on to places like metals, which have done very, very well. There are still financials and banking stocks, which like PSU banks, for example, which have just started to fall from peak prices. So a lot of places where people can look at unwinding and increasing cash if they've been exposed to those segments which have been doing well. Probably what you hold on to are defensive areas like pharmaceuticals, for example. Those have done well and are probably holding out better in the market. Defense stocks simply because they relate directly with the war. And maybe alternate sectors somewhere related to agro commodities. I specifically like sugar because somewhere it has the sugar cycle or even the ethanol indirect demand case based on high oil prices that can be make it attractive. So some of the segments that you can stick with, but on the other hand, many others which have done well is where you actually need to create cash, and you can create cash.
All right. And finally, what about foreign investors? Because you were talking some time back about looking at the US bond market and also about the strength of the US dollar. But this morning, again, the Indian rupee has opened weaker against the US dollar. It's again ahead of that 92 level. In fact, 92.2 against the US dollar is what we are picking up. Meanwhile, all of last week, foreign portfolio investors have pulled out as much as 21,000 crore rupees, or that's about $2.3 billion from the Indian equity market. So where does this sort of, leave the Indian stock market as far as its vulnerability is concerned to foreign money flowing in or flowing out of the country? Where do you see sort of, the FII money really going right now? And how much of a dent is that going to be for Indian retail investors if foreign inflows don't come back?
The foreign flows have not been positive for years. So when we look at it that way, it's been the domestic flows that have helped the market. The problem really, therefore, would be when domestic flows slow down or domestic money starts withdrawing out of fear from these markets. That is what would cause a bigger reaction than just foreign investors selling. The foreign investor selling is having the most direct impact at the currency level. That is for sure. The Because our currency is being funded by either foreign portfolio flows or FDI or remittances from the Middle East or various other regions where a lot of Indians reside. So these are the couple of sources from where our reserves have been built up over time. Because our current account deficit historically has been negative, even though we brought it down over the last 20 years from 4% to 1%, it's still a negative number, which means we import more than we actually export. And it is the other sources of funds that ends up supporting the rupee. So if the other sources of funds dry up, it causes a currency concern. And that doesn't really help the case for foreigners coming in. But the real reason why foreign investors haven't been investing for a long time, in my belief, has been the taxes that we put on them way back in 2018
Right.
through long-term capital gains.
All right. Well, let's leave it at that this morning. Thank you so much, Rohit Srivastava, for joining us. Always a pleasure having you here with us on News 9.